Okay, chapter 4. Last chapter, in chapter 3, we went over T accounts, different types of accounts, assets, liabilities, equity, revenue, expenses, and even T accounts. So in the real world, those aren't used. What's used are called journal entries. So in this PowerPoint, we'll look at journal entries, posting them, and they're called the original book of entry, the general journal. The general journal is then posted to a ledger, and that was the whole emphasis of the T account. T account was representation of the ledger. But let's go ahead and get started. So section 1, objectives: record transactions in a journal. So you'll have a debit, an account name, an amount name. I'm sorry, an amount. Then you'll also have a credit, and you always post the debit first, or record the debit first, then record the credit. So we'll have the credit name and the credit amount. Then we're going to prepare those journal entries. So here's the different steps in the accounting cycle. So we'll analyze a transaction, journalize it, and post it to the ledger. Those are the steps we'll be looking at in this chapter. Then subsequent chapters will prepare a worksheet, financial statements, journalize adjusting entries, have closing entries. That's when we have our revenue accounts and expense accounts closed out. Those are temporary accounts, and those get closed out to the capital, which is on the balance sheet. Then we prepare a post-closing trial balance, and step 9, evaluate and communicate the information. And each month or each period, this whole process starts over. So it's a never-ending cycle. So here's the journal. A journal is a diary of business activities. So anything that you do in the business that is actually a transaction gets recorded in the general journal. So the different types of accounting journals: transactions are entered in the journal in chronological order. So whatever happens on, just say, 9/1 gets recorded before 9/2, and so on. So we'll always have steps in order 1 through 30 as far as the days in the month, or if it's February 1 through 28. So here's an example of a general journal. Here we'll have the debits and credits and the amounts over here. So here's an example. So we enter the account. First thing we do is enter the account to be debited. So this example, we're going to debit cash, and the amount is $100,000, and we're going to credit capital for the same amount. So we always put the debit first and the credit second. The credit's indented. So I'm more focused. Of course, that's the right way to do it, so you can visually see it. But I'm more focused on that you're choosing the correct account. So we're increasing cash here, which is an asset. So we're debiting an asset. And we're also increasing capital, two favorable things. So a debit and a credit are neither good nor bad. It just depends on the actual account that's being debited or credited. So here's an example of a journal entry. Then we enter a complete but concise description of the transaction for more of an audit trail. So this is basically the initial investment by the owner, and typically the first investment in the books of a company. So we should always refer to the source of information. So document numbers are part of the audit trail, like I mentioned before, memo 01. So I would say that's the least important to remember. Just keep in mind that we want to have a debit, a credit, and their respective amounts, and a little explanation here about what's going on. So, recording a business transaction, we analyze the event, identify the accounts. So we identified in the prior example cash and capital, classify the accounts affected, determine the amount of increase or decrease for each account, apply the rules of debit and credit. So we've seen in prior chapters that assets and expenses and drawing increases with debits and decreases with credits. Same thing. So we make the T account, So that T account was a representation of posting in the ledger, and we'll see more. We'll have a better visual of that on the second part of these slides. So here's a journal entry we just did. On November 6th, Wells withdrew 1,000 from her personal account into the business. So she basically started the business with this amount of money. And in the general journal, we have pages, and that'll come into play when we start posting. So here's a second transaction, purchase of equipment. So they issued a check of the company's money to purchase $5,000 of equipment. So we're decreasing cash and we're increasing an asset. So think of the accounting equation. That whole accounting equation was just prepped to make you have a mental visual of what's going on. So assets equals liabilities plus owner's equity. This transaction is just happening on the left side of the equal sign. So it's affecting assets. We're decreasing assets and we're increasing assets. So, excuse me, when we increase equipment, we debit it for 5,000 and we're spending cash for 5,000. These will always be the same. Sometimes, and we'll learn later, that when you have more than one debit and more than one credit, you can have something called a compound entry. So, for an example, if we bought equipment for 5,000, but we gave them 2,000 in cash, and we paid the rest on account, we'd have, this would be 2,000, and 3,000 would be in something called accounts payable, a credit to accounts payable. That would be an example of a compound entry. So here's an example. If we didn't pay in cash, we paid the whole thing on account, which is, hey vendor, I owe you in 30 days or 60 days. This is how we would record it. And then notes down here, we basically, we owe Office Plus the invoice number here due in 60 days. So when we pay it, we're going to debit accounts receivable to get rid of this liability and credit cash. That's in 60 days or before. We purchase supplies for cash. So same premise here. We are increasing an asset and decreasing an asset. So we're paying Office Plus here, partial payment. So instead of paying, I believe that was $6,000, we're paying $2,500 of that. So think T accounts. I think if we have accounts payable, just make a little T account here, visualize it. We had the balance of 6,000 here. Now we're debiting it for $2,500, and the balance would be a credit balance, would be 6,000 minus 2,500, and that balance would be over here. Think of that, visualize it for each of these accounts. So we're decreasing accounts payable here by debiting it, and we're decreasing cash by crediting it. Oh, I think I skipped a slide. There we go. So recording a prepayment of rent. So basically what we're doing here is we're going to our landlord and we're saying, okay, I'm paying you now for 2 months. So we record that as an asset, and as time passes, we debit an expense and credit that asset to reduce it. So right now, we're going to pay everything, basically pay it in full. And think about it for your car insurance. If the company had car insurance and they paid the annual premium up front and did not have a monthly payment, they would incur an expense each month. So just say if it was 8,000, we divide that by 12, and that would be expensed each month. So in this example, prepaid rent, $8,000. We're increasing an asset, decreasing an asset by paying in cash. So services performed for cash. So we are creating revenue here, and our customer is basically giving us cash. So we're going to debit cash for $36,000 and credit fees income, which is our first income statement account, for $36,000. So now we are selling services on account. So Wells Consulting is, just say, is doing business for me. They gave me a service and they're saying, hey, Jim, here's an invoice you owe us in 30 days. So that I owe you, so I owe them money within 30 days. You record that in the business as an asset, as accounts receivable. And as you see, and we'll see in a subsequent slide that when I pay, they're going to debit cash for that amount and reduce the accounts receivable by crediting it. And here we go. So receive 6,000 in cash from a credit client on account. So anytime you see the word credit or on account, and it can go both ways, accounts payable, accounts receivable. So in this case, we are offering a service. We're collecting cash. So in that prior example, I'm paying them $6,000. They are increasing cash with a debit and decreasing crediting accounts receivable because I've paid. So that IOU is no longer on the books for $6,000. So the company pays salaries of $8,000. Salaries expense, this goes in the income statement. It reduces net income, or your revenue. Revenue minus expense equals net income. And we're decreasing cash because we're paying for salaries. Same thing with utility. Utilities expense, debit, credit, cash. The owner, Carolyn Wells, withdrew $5,000 from the company. Drawing is not an expense, but it's treated like an expense with the debit and the credit rolls. So drawing, we're going to debit it for $5,000 and credit for cash. So basically, Carolyn Wells is taking her business check and depositing into a personal account, which is no problem there. That's the whole reason why we're in business, is to make money for the most part. So here's the general ledger. General ledger is after you post the journal entries, or after you write down your journal entries, you post them into the general ledger. And the general ledger basically keeps a running account of each transaction. As you can see, it's better for an audit trail. And we'll talk about errors as well. So the ledger contains a separate form for each account. Third step of the accounting cycle is posting to the ledger. So this is the process of transferring data from the journal to the ledger, and that process is called posting. So what is posting? It's basically just a process of transferring data from one source to another. In other words, going from the journal to the ledger. And as we can see, that's step 3. So ledger account forms. Here's an example of cash. Cash is going to be used the most. It's going to be the most lengthiest, and you'll see the transactions in here. So you'll have the date, a reference from the page of the journal. So journal, page 1. We had a debit balance. That's when we initially put money into the company. And you take that at 100,000 and you just bring over the balance. There was no previous balance, and it's going to be the same. So we have the account name and the number right there. Columns for the date, description, and posting reference. And columns for debit and credit, and the debit balance and the credit balance. So we have quite a few steps for posting. So on the ledger form, enter the date of the transaction. So this looks more harder than it really is. Basically, it's just basically stating what we circled in the previous slide. Enter a description if necessary. On the ledger form, enter the general journal page. On the ledger form, enter the debit amount and the credit amount. On the ledger form, compute the balance and enter in the debit balance column or the credit balance column. So on the general ledger, enter the ledger account number in the post reference column. So this slide is basically just, again, stating what we did in the last slide. So step 1. So here's an example of a journal entry that we purchased equipment. And here's the equipment balance, or the equipment general ledger. And here's the journal entry. So we're taking this and putting it here. So here's the date. J1 is the journal, page 1. And here's the balance of 5,000. It didn't have a previous balance, and it's 5,000. So if it had a previous balance of 10,000, this would be 15,000. Step 2. So it's basically saying the letters J refers to the journal. And here's the amounts. And here's the amount balance. So we have the account number. This 141 will go here. I'm sorry, this 141. You're going to go back and post into the journal. You're going to put reference post 141, and that's going to tell you that you posted this into the ledger from the journal, so you don't have to post it twice. So the balance sheet appears first in the journal ledger, and followed by the income statement account. So here's the typical order. You have assets, liabilities, owner's equity, revenue, and expenses. So the order of the accounts speeds up preparation of the trial balance and the financial statement. So what we're going to do here at the end of after we're done posting, we're going to create a trial balance. Then after that trial balance, we're going to have adjustments. Then after the adjustments, we'll have an adjusted trial balance. Then we can make the income statement and the balance sheet. And that whole process is called a worksheet. So some errors. Sometimes errors are made when recording transactions in the journal. The method used to correct actually depends on whether the journal entry was posted to the ledger or not. We'll see examples. If an error is discovered before the entry is posted, you can basically cross it out in the journal and write the correct account that should be used. Again, this provides a good audit trail. We don't erase in the journal. If we discover an error before posting, so here's an example. On September 1st, an automobile repair shop purchased some shop equipment for $18,000. By mistake, they debited the accounts equipment the office equipment instead of the shop equipment account. So in general, assets would still be the same, just it's in a different account. So here's the original entry. So we basically just cross that out before we post it and put shop equipment. So, and we post it to the journal ledger in the usual manner. So after you post it, here's a little bit different. This is what we do. Don't erase or change anything in the journal. Never permitted. So same journal entry. The debit was posted to the office equipment account in the journal ledger. So it went from the journal to the ledger. Now we have to post something called a corrective entry. So here is the actual entry before we discovered the error. So it was posted to the journal incorrectly. Posted to the ledger incorrectly. So now we just flip-flop. So it was originally this. We originally debited office equipment. Now we're going to credit it to make that a zero balance and debit the right asset. To correct the error made on September 1st when a purchase of shop equipment was recorded as office equipment. So, and this is an example after it has been posted. So before it's posted to the ledger, we can cross out. After, we have to have a correcting journal entry. So that's the end of chapter 4. So any questions, feel free to post them in class, and